Forget everything you think you know about Roth IRAs, because the rules you assumed were blocking you from tax-free wealth were never actually walls. They were doors left slightly open. Today, we're kicking those doors wide open with two of the most powerful, completely legal retirement strategies most people have never heard of: the Backdoor Roth and its big sibling, the Mega Backdoor Roth. Here's the tension. The government says if you earn over a certain income threshold, you can't contribute directly to a Roth IRA. And for a lot of high earners, that feels like being told you make too much money to win. But the tax code, written by the same government, quietly left a side entrance unlocked. And the people walking through it aren't breaking rules, they're just actually reading them. Let's set the stage technically so we're all on the same page. A Roth IRA grows your money tax-free, lets you withdraw it tax-free in retirement, and asks nothing of you at the end. No required minimum distributions, no surprise tax bills, just freedom. The catch is the income limit, which phases out around $146,000 for single filers and $230,000 for married couples as of recent years. Here's where the Backdoor Roth enters: wearing no cape, carrying no drama, just a quiet confidence. Anyone, regardless of income, can contribute after-tax dollars to a traditional IRA and then convert that money into a Roth IRA, which is completely legal and has been acknowledged by Congress since 2010. That's it. That's the whole move. Not a glitch, not a gray area, but a straightforward two-step process hiding in plain sight. The irony is almost comedic. The strategy sounds scandalous enough that people assume it must be shady, when in reality, it's one of the most boring, well-documented tax maneuvers in the entire IRS playbook. Think of it like finding out there's a fast lane on the highway that's always been there. You just never noticed the sign because you assumed it was only for someone else. Now contrast this with the average investor's psychology. Told they earn too much for a Roth, they shrug, accept a taxable brokerage account, and quietly watch their gains get nibbled away every year by capital gains taxes. Meanwhile, the investor who spent 45 minutes learning the Backdoor Roth is watching the same dollars compound, completely untouched, same income, same risk, completely different outcome. History actually validates this strategy through cycles of skepticism and adoption. When the income conversion rules changed in 2010, financial advisors called it a game changer. Then the internet called it a loophole. Then Congress reviewed it and kept it anyway, because it was never a loophole to begin with. Every few years, someone predicts it'll get shut down, the community panics, and then nothing happens, which tells you something important about how durable this strategy actually is. Now, if you're a business owner or self-employed, buckle in, because this is where the Mega Backdoor Roth enters the chat and changes everything. A solo 401k allows you to make both employee and employer contributions. And within that structure, you can direct those contributions as after-tax Roth contributions, regardless of your income level. We're talking a potential of over $70,000 per year per person, growing completely tax-free. Married and both running businesses? You're now looking at over $140,000 per year going into a tax-free compounding machine, which over 30 years at a modest return could represent millions of dollars never touched by the IRS. That's not wealth management, that's wealth architecture. And the blueprint has been available to anyone willing to pick it up. Let's address the misconception directly, because someone in the comments is already typing, "Isn't this just for rich people gaming the system?" The strategy is available to a freelancer making $60,000 who sets up a solo 401k just as much as it is to a surgeon. Making $700,000, the income floor is the same for everyone, zero. What separates the people using it from the people not using it is simply awareness, not wealth. The practical lesson history teaches us here is deceptively simple. The tax code rewards people who plan proactively, not reactively. You don't need perfect timing, a crystal ball, or a hedge fund manager. You need a consistent strategy, the right account structure, and the discipline to fund it every single year without letting emotion or market noise derail you. Position sizing matters here too, because the mistake isn't failing to use the strategy, it's going all in without understanding the pro rata rule, which can create an unexpected tax event if you have existing pre-tax IRA dollars sitting around. Keep your traditional IRA clean. Roll pre-tax funds into your employer plan if possible. and execute the conversion cleanly each year. Process beats conviction every single time. Philosophically, what this is really about is choosing to be a student of the system rather than a victim of it. Discipline in funding these accounts annually, consistency in the conversion process, and patience in letting tax-free compounding do its quiet, relentless work. Those three things, done without drama, will outperform almost any hot stock tip or market timing strategy you'll ever encounter. You don't have to be a genius, a millionaire, or even particularly aggressive to win this game. You just have to know which doors are open and be willing to walk through them. The Backdoor Roth and the Mega Backdoor Roth are two of the widest, most welcoming doors in the entire tax code. And the only thing standing between you and the other side is the decision to get started. If any of this sparks something for you, whether it's building tax-free retirement wealth, investing in real estate, finding the right contractor, or connecting with a lender who actually gets your goals, check out the links in the description below and let's map out your next move together.